As we wrap up the first quarter of 2025, it's a good time to take stock of where markets stand. On a macro level, things look relatively stable. Expectations for the economy is generally still optimistic but evolving. And when we speak to our clients in Asia, the mood is still upbeat. Risk appetite remains high with low cash allocations. Themes like US exceptionalism and Republican traits continue to drive sentiment. As for the direction of interest rates, the expectations is still for cuts, but while there's optimism, we should also be aware of the risks. Recent macro data is showing signs of cracks. Inflation is coming down, but it's not a straight path. Geopolitical tensions, supply shocks, and uneven monetary policies are still in play. As at the end of the first week of March, the S&P 500 is underwater for the year as AI developments and earnings fail to meet lofty expectations. Other major markets are outperforming the US. Both European and Chinese tech stocks are rallying, marking a turnaround from where we were this time last year. So, is this just a short-term market blip, or are we seeing a bigger rotation in play? At Fidelity, we don't just look at the macro picture. Our research has always been at the heart of our investment approach, helping us identify opportunities that at times go against market sentiment but have led to strong outcomes over the long term. We release our findings in an annual Analyst Survey, which taps into insights of over 100 analysts who cover sectors and companies across the world. And while past performance is never a guarantee of future returns, understanding these trends can help us to see the bigger picture and spot opportunities ahead. So, what are the key takeaways from 2025's survey? We are highlighting 3 themes in this video. First, one clear trend stands out. Optimism is back. Our research has found that company managers worldwide are feeling more confident than they have been in the past 2 years. Many sectors anticipate a wave of M&A activity, driven in part by the change in US administration. The hope? A more business-friendly regulatory environment that could unlock strategic growth opportunities and fuel deal-making across industries. The second theme reveals that while AI has been one of the hottest topics in tech, real returns are still a few years away. In fact, 72% of our analysts believe that AI will have no impact on company profitability in 2025. But that doesn't mean that the hype isn't real. We expect more companies to increase their spending in AI this year. So, where should we look for the AI winners of tomorrow? When considering AI benefits, investors have predominantly focused on a narrow subset of tech sectors, particularly enablers like hardware and semiconductors. Investors should broaden their allocations and consider more variables including valuations when seeking out AI opportunities. While tech sector has driven momentum of US stocks, global opportunities, for instance in China, are emerging. We believe markets will begin to focus on adopters of AI. Sectors like healthcare and finance stand out to us for their long-term potential in the AI space. Understanding industry dynamics and company fundamentals will be vital for investors looking to capitalize on the future of AI. The third theme our research has highlighted looks at how China's policies are shifting in 2025. While economic growth has faced headwinds, the government is taking decisive steps to stimulate domestic demand and drive innovation. Our analyst research aligns with recent announcements at the NPC, which highlight bold goals for 2025 and key focus for long-term growth, including consumption, AI, and tech self-reliance. The key takeaway? China's policy shifts are unlocking new investment opportunities, but staying ahead requires a focus on sectors positioned for long-term growth. According to our research, high-tech and AI, domestic consumption, green energy, and financials stand out as key areas of potential. Importantly, investors should also consider companies with strong long-term fundamentals that are currently trading at deeply discounted valuations. Consumer stocks in particular have been amongst the most overlooked, with sentiments at historical low. We have been building positions in leading consumer franchises where investors may be underestimating strong balance sheets and market leadership, key drivers of growth supported by long-term structural trends.